Hey everyone, welcome back to my Robinhood portfolio. This is going to be my first video in this series, and we're just going to track my progress. So as you can see, my portfolio is around $9,000. It's down about 1% for the week. It's up about 3% for the month, and in the year it's up 8%. Now, about a third of this portfolio was purchased in 2019, and the majority of this portfolio was purchased last year. I have about $700 in cash, $300 in buying power, and about $450 in a limit buy position for Tesla. I'm looking to buy Tesla around $145 to $100. I did a great trade where I made about 30 to 40% on Tesla and cashed in, so I'm looking to repeat that. So with this portfolio, I tried to invest about $25 to $50 per week, and my goal is to grow it to around $20,000 by the end of the year and hopefully to $1 million eventually. Let's take a look at my individual holdings in this portfolio. Before we go into my portfolio, I want to kind of go over my strategy for my growth and dividend portfolio. So with stocks, I try to keep it super simple and invest in, companies that I either use a lot or I think have excellent long-term opportunities. If you're a new investor, I would recommend like more broad index stuff. They're generally safer. In the ETF world, you can, instead of taking risk with one company, the ETFs kind of have less risk because you're spread out, you're diversified. So I also contribute to this portfolio after I make a successful trade. I usually allocate a portion of that trade to maybe around one share. So if I was looking to buy Stag at the time, I'd probably buy $35 worth of Stag. All right, let's look at Starwood Property Trust. I have about 39 shares. The market value is around $800, and my average buy-in is around $22.40. So unfortunately, I'm down around 10%, but again, I'm a long-term investor. The fact that I'm down 10% today doesn't matter to me as I'm looking for in more of a long-term approach. So one of the reasons why I like Starwood is because of the dividend it produces. I only have $800 in it, but I get a dividend that I can show here. I get $17 was the latest dividend, and that was January. But, obviously every quarter I get that $17 and it's growing. You can see I started off $2, then obviously invested more money, got to the $13 mark, and it's just grown from there. Then it went to 14, 14.30, and then now 17. Now let's look at one of my personal favorites, Stag. I have around 19 shares in Stag. Market value is around $700. With this company, I'm up around 15%, and I'm really invested into it. Like Starwood, it is a REIT, but because of the dividend that it produces. And the reason why Stag is up on one of the top list of REITs of a lot of investors' portfolio is because of the monthly dividend that it produces. So every month I get a guaranteed dividend of $2.35. And just like with Starwood, you can see the compound over time increase the dividend. And most of my dividends are investing back into the company so I can really take advantage of that compound interest. The third company is called Glad. I think this is my smallest holding, only $130. I'm up 10%, and again, it does have a dividend, but because I only own $100, obviously the dividend is very small. Just around, I'm getting up to $1. But one of the reasons why I was hesitant on the AG&C is their growth, their long-term growth was declining. Like they didn't have a lot of long-term growth, so I'm not investing a lot into it at the moment. The next company is Lowe's. Lowe's and Home Depot did fantastic during COVID for obvious reasons, and that's when I really started to pay attention to them. They really became a stable company at that time, and I think their growth moving forward will be fantastic. If you think about the home improvement front, it's really only Lowe's and Home Depot. Those are the huge companies that kind of just rule the market. I have around 2.5 shares. That's around $520. My average cost is $190, and I'm up around 10%. I haven't owned this stock for a super long time, so my dividends aren't too much. So yeah, I've received 2 dividend payments. The first one was $1. Second one is $2.50. Not bad. Next company is O, or Realty Income. It's probably the number one company in terms when you think of a REIT or dividend income. I would say most dividend investors value this very highly. I own around 7 shares. That's $500. Priced in at $63. I'm up around 5%. And again, I get a dividend to compound that interest. So yeah, you can see 10 cents, 10 cents, 10 cents, and 50 cents, 80 cents, $1.60, and then $1.71. Now with the big jumps, that is attributed to more money being invested in the stock. But something like $1.63 to $1.71, that is natural growth of the compounding interest. The next share is QYLD, and this is going to be 100% the stock that is regarded as, maybe not all investors will agree with me, but I have $3,800 into it. I'm down about 6.5%. I own about 224 shares. It's about half of my portfolio. And this covered call ETF has a 12% return on it every year. So my dividend income that I make is I get around $37 every month. So just from investing in this ETF, I've made around $180 to $190 just from basically having my money parked into it. One of the things you do have to worry about with QYLD is the negative growth that comes with it. However, if you don't necessarily care about the value of your money invested in the company, but only the income that it produces, it can be an excellent tool. And something that I would also suggest is JEPI and RYLD. They're also 2 covered calls or premium income ETFs that really take advantage of that risky to high dividend yield that can sometimes be a trap. The next one is Acre. I think I only have $25. Honestly, it's not even worth mentioning. It was just something that I thought might be a good prospect, but I figured my money was in welcoming in other deserving areas. Same thing goes for PSEC. I only have $30 invested into it, not even worth mentioning. Something that a lot of people will be familiar with is SCHD. It's the Schwab US Dividend Equity ETF. And I have around $300. I'm up 6%, and it also offers a great dividend. 66 cents and then $2.30. The next company is ABBVIE. It's a pharmaceutical company. You probably see commercials for their products all the time. It also offers a great dividend. I have around 1.68 shares, $255 in market value, and an average cost of $146. Now I'm up around 4%, and this company is just only going up. It's going to continue to acquire more assets in the pharmaceutical area and only acquire more assets and looking to go up, I think. Obviously not financial advice. This is more of an educational video. Now, I owned NLY for 3 to 4 years, and it went through a stock split, which really hurt, obviously, the number of shares I have, and not very happy. This is probably one of my worst investments. Down about 36%, really got hit hard with COVID. You know, it is what it is. Hopefully it bounces back. All right, fourth to last, we have Microsoft. Everyone's heard of Microsoft. They're really doing revolutionary things. Great company to be invested in. I have around $400 in it, 1.4 shares, up about 15% because I was able to buy it on the about 20% dip that the S&P took. Obviously, stocks have been doing great the last 2 months. I don't expect that to continue. I expect us to have a bullish first quarter, and that might lead into quarter two, but I expect at some point in quarter three or quarter four to be extremely bearish. Next stock is Johnson & Johnson. Again, most people have heard about this. You know, it's gloves, vaccines, medical equipment, baby powder, just everything. I'm down 6%, 1.5 shares, market value is $245. My average cost is $172. Right now, the stock's at $161. Again, I think this company is a company that's not going anywhere. It's going to stick around for a long time. And when companies stick around for a long time, their tentacles seem to weave into other assets that they weren't in before, and the company spreads. And a lot of time that will show growth in the stock. It will also show maybe a dividend bump. So a lot of good things coming from Johnson & Johnson. And the last one's Apple. Obviously, everyone knows Apple. I don't own a lot, just $34. Just looking to kind of, you know, become familiar, just dip my toe in the pond a little bit. It's obviously, I think, a very safe stock, not going to move a lot, even with the bumpy ride of, you know, COVID 2022, the bear market, the recession coming. Apple hasn't really moved a lot. I think it's a safe investment, even offers a little bit of a dividend, and it looks to put your portfolio in a good position. And then the Tesla at the bottom is what I talked about with just trying to catch Tesla in this 145 range. And then hopefully if it goes below there, the $100 range, try to pick up some and then catch the bounce to 200, 300, whatever. So yeah, that's my Robinhood portfolio. I'm looking to do these videos maybe once every week to recap how I'm hedging the market and where I think my money will be best served. So, thanks.